For 45 years, ever since the Hunt brothers faced ruin in 1980, a global banking consortium has exerted immense pressure on the silver market. They propagated the myth of inexhaustible supply, portraying silver merely as an industrial commodity, and advised divestment at $30, then again at $50. However, today, Wednesday, December 10th, 2025, at precisely 9:30 a.m. Eastern Standard Time, the banking cartel has made a concession unseen for half a century. They have capitulated. Observe your displays. The spot price of silver is currently trading at $61.75. This figure transcends mere valuation. It signifies a monumental transgression, the audible manifestation of billions of dollars in uncovered short positions dissolving in real time. It represents the dawning realization for Bank of America, JP Morgan, and their ilk that their paper-based schemes have reached their conclusion. The $60 threshold, their perceived bulwark, has crumbled. What lies beyond this level is not a barrier, but a testament to the downfall of financial institutions and a reward for the prudent. The mainstream media will likely characterize this event as a market squeeze or a speculative bubble, attributing blame to online forums, international markets, or even individual investors. Yet the truth is far more profound. This is not a bubble. It is an escape. For 4 decades, the price of silver was artificially suppressed, preventing it from reflecting its genuine worth. Now it is finally beginning to speak truth. In the forthcoming 30 minutes, I will meticulously dissect the collapse of what may be the most significant short squeeze in human history. I will illustrate the precise financial losses incurred by these banks with every fractional increase in the silver price. I will elucidate the critical failure of commercial market signals, a technical indicator confirming the complete loss of control by market manipulators. Furthermore, I will demonstrate why $61.75 represents not a peak, but the very genesis of a surge towards $100 for those who have maintained their positions. If you were steadfast in accumulating silver while others scoffed, if you purchased it when prices were artificially depressed, this analysis is for you. Take solace in this victory, for the banks have unequivocally lost this battle. To fully grasp the significance of today's events, one must comprehend the importance of the $60 mark. In military strategy, the Maginot Line was a French defensive fortification designed to deter German aggression, intended to be impregnable. For bullion banks, $60 served as their equivalent Maginot Line. Why? Because exceeding this price point destabilizes the complex calculations within the derivatives market. Banks do not merely trade silver, they trade contracts, typically for 5,000 ounces. When a bank initiates a short position, they commit to delivering a specified quantity of silver at a future date for a predetermined price, a practice that has persisted for years. Historically, whenever silver approached $30 or $50, these institutions would issue millions of such contracts, essentially creating synthetic silver out of thin air to flood the market, instilling fear in buyers and consequently driving down the price. This tactic proved effective in 2011 and again during the silver squeeze of 2021. However, this strategy is fundamentally reliant on psychological manipulation, specifically fear. The Silver Institute reported a deficit of 237.7 million ounces in 2023, followed by another 140 million ounces in 2024. In 2025, this deficit widened further to 215.3 million ounces. And as we conclude the fiscal year of 2025, preliminary estimates suggest an additional 200 million ounces have been consumed. Cumulatively, since the commencement of this decade, we have experienced a structural deficit approaching 800 million ounces. This figure, however, only accounts for reported shortfalls and does not include the significant outflow of investment silver from exchange-traded funds into private holdings. When factoring in the depletion of the London Bullion Market Association vaults, which diminished by 30% from their peak in 2021, and the surge in retail accumulation, the actual deficit exceeds 1.1 billion ounces. Consider the implications. The global mining industry produces approximately 830 million ounces annually. This means that over the past 5 years, the demand has outstripped global production by more than an entire year's output. Where did this additional silver originate? It was drawn from dormant reserves, the billions of ounces held in London vaults, residual stockpiles from the 1990s, and government reserves. Essentially, we have been drawing down our principal savings to meet daily expenses. This practice was actively encouraged by the banking cartel. As long as a reserve of phantom silver was available to be injected into the market, they could point to the vaults and assert, "See, ample supply, no shortage." Yet, mathematical principles are immutable. A perpetual deficit is unsustainable. Eventually, the savings account will be emptied. This is precisely what transpired this week, leading to the breach of $59. The ghost silver has been exhausted. The readily available metal within the LBMA for lease has dwindled to effectively nothing. Registered inventories within the COMEX system are at critically low levels. Consequently, every new solar panel, every advanced missile system, every modern smartphone must now be constructed using silver mined in the immediate present. There is no longer a buffer, no reserve cushion. In markets characterized by inelastic demand, where consumption is imperative regardless of price, the absence of a supply buffer does not result in a linear price adjustment. Instead, it triggers a vertical ascent. The 1.1 billion ounces did not simply vanish. They represented the anchor tethering the balloon to the ground, and that tether has now snapped. Skeptics, however, might argue that escalating silver prices, whether to $60 or $80, would inevitably suppress demand. They suggest that solar manufacturers would pivot to copper or reduce silver usage. This contention is currently the most significant fallacy propagated on Wall Street, and I intend to dismantle it with a single acronym: TOPCon. For years, the solar industry relied on PERC technology, which, while efficient, utilized approximately 10 milligrams of silver per watt. PERC technology, however, reached its performance plateau. In the energy sector, efficiency is paramount. Therefore, the industry transitioned to TOPCon and HJT cell technologies. The predicament for the banks is that those holding long positions, those anticipating the upward price movement, are not inclined to sell at $61. They are holding out for $70. This forces the banks to bid prices higher, creating a bidding war amongst themselves and other distressed institutions. This is a classic short-covering rally, characterized by extreme price volatility, driven not by market fundamentals, but by the sheer imperative of survival. Bank of America stands as a particularly significant entity in this scenario. Reports from the Office of the Comptroller of the Currency in 2024 indicate a substantial expansion of Bank of America's derivatives portfolio in precious metals. They had positioned themselves as the lender of last resort, absorbing short positions offloaded by JP Morgan. Presently, Bank of America faces an existential threat. At prices of $61 or $75, their derivatives book represents a ticking time bomb within their vault, necessitating urgent covering of their positions. Their forced buying activity is poised to propel prices to $70 by Friday. This is the anatomy of a default. The financial leverage that suppressed prices for decades has now reversed course, acting as a powerful propellant for upward movement. For traders observing the technical indicators, the signal failure of commercial entities is undeniable. For the past 40 years, a predictable pattern prevailed. Silver prices rose. Banks increased their short positions, leading to price declines, a self-perpetuating cycle that generated substantial profits for trading desks. However, examining the data from the past 2 weeks reveals a critical anomaly. As silver climbed from $55 to $60, banks did not escalate their shorting activities. In fact, open interest actually decreased. This signifies a cessation of their defensive maneuvers, a recognition that the immense buying pressure originating from the East is insurmountable. The system, designed to control prices, has faltered, and the algorithms governing market behavior have been deactivated. This shift is largely attributable to the Basel III net stable funding ratio. Years ago, this regulation was discussed, but its impact is now acutely felt. New banking regulations impose significant costs on institutions holding unallocated paper, gold, and silver liabilities. The requirement for physical backing is paramount, yet the physical supply is severely depleted. Consequently, compliance departments within these banks have instructed their traders to liquidate positions due to prohibitive capital charges. Therefore, the banks are not only incurring losses on their trades, but are also being compelled by regulators to exit these positions, transforming them into forced buyers in a market with virtually no available inventory. This is why $61.75 represents a fundamentally different price point than $50 in 2011. In 2011, banks actively fought to suppress the price. In 2025, they are desperately attempting to extricate themselves from a collapsing market. When the manipulator becomes a buyer, the price ceiling becomes indeterminate. The Indian whales, astute observers of the emerging deficit, recognized the impending shortfall long before the Western markets. They anticipated the immense silver requirements for the burgeoning solar factories in Gujarat and the strategic significance of the Gift City Exchange's emergence as a challenger to Western financial centers. Consequently, they acquired silver at its nadir, purchasing it at $22 and $24, effectively depleting London's vaults while the LBMA remained complacent. Now, as silver approaches $59, one might assume that India would divest to realize profits. This is a misconception. In India, silver is not merely a speculative asset, it is a store of value, often referred to as the poor man's gold, and also a vital industrial input for the affluent. The silver that entered India has been transformed into jewelry or integrated into electronics manufacturing, thereby exiting the speculative market. This is central to the narrative of the 1.1 billion ounce deficit. The missing silver has not evaporated. It has transitioned from speculative hands to secure ownership. The West is now confronting a stock shortage, realizing they divested their financial insurance to the East at a fraction of its true worth. JP Morgan, with its sophisticated tracking of market flows, witnessed the departure of 73 million ounces in February of 2024 and the subsequent outflow of thousands of tons throughout 2025. This explains their cessation of short-selling activities and the ineffectiveness of price suppression tactics. It is impossible to manipulate a market devoid of physical assets, and a flash crash is inconceivable when India stands ready to absorb every price dip. The substantial acquisitions by Indian investors have effectively broken the back of short sellers, compelling the West to pay a premium for any available silver. Consequently, we find ourselves on December 9th, 2025, with silver at $59. The ensuing phase is the entry into a market vacuum. In technical analysis, resistance levels are established by individuals anticipating selling opportunities. For instance, an investor who purchased silver at $30 5 years ago might sell at that price to break even, thus creating resistance. However, who acquired silver at $65, $75, or $85? No one. There is no overhang of supply from sellers eager to exit their positions. This signifies a clear technical runway, a blue sky breakout. When an asset surpasses its all-time high, it enters a phase where further price appreciation is the primary mechanism for discovering sellers. We observed this phenomenon with Bitcoin following its ascent past $20,000, propelling it to $60,000 within months, and similarly with Nvidia. Now it is silver's turn. Beyond this technical breakout, another critical target emerges directly from the 1.1 billion ounce deficit calculation: $100. Why $100? It is not merely an arbitrary round number. If one adjusts the 1980 peak of $50 for inflation, utilizing government-calculated consumer price index figures, that $50 would equate to approximately $170 today. Therefore, at $59, silver remains historically undervalued, still approximately 60% below its inflation-adjusted all-time high. Psychologically, however, $100 acts as a powerful magnet. The vacuum effect operates as follows. Firstly, short positions are covered as hedge funds facing liquidation are compelled to buy regardless of price, prioritizing survival. Secondly, the fear of missing out, FOMO phenomenon, will drive retail investors who previously overlooked silver at $25 to enter the market upon seeing it at $60 on news channels. Thirdly, and most significantly, an industry-wide panic will ensue. When major corporations like Tesla and Samsung realize the depletion of the 1.1 billion ounce buffer, their purchasing strategy will shift from opportunistic buying to precautionary hoarding. This hoarding action creates scarcity, which in turn drives prices higher, further incentivizing hoarding, a vicious cycle for banks but a highly beneficial one for physical silver owners. The disappearance of 1.1 billion ounces has created the conditions for this market vacuum, and nature abhors a vacuum. Price will surge to fill this void. I anticipate a rapid ascent from $59 to $75 before the close of the year, and $100 is a realistic target for 2026, not a distant projection. The 1.1 billion ounce deficit was not an accidental occurrence, but a deliberate transfer of wealth from the impatient to the patient, from proponents of fiat currency to adherents of tangible assets, and from the West to the East. For 5 years, the data was conspicuously signaling the impending crisis. The Silver Institute's reports, LBMA vault data, and Indian import figures were publicly accessible, providing ample opportunity to observe the emerging deficit and acquire silver at $22, $25, or $30. However, many heeded the pronouncements of the media and financial institutions instead. Now the buffer is depleted, the $59 threshold has been breached, and the market vacuum is pulling prices upward. If you are viewing this and still hold unallocated paper assets such as SLV or pooled accounts, you are essentially seeking shelter in a burning structure, hoping the insurer remains solvent. Acquire physical metal while it is still obtainable, as the 1.1 billion ounces that vanished will never be replenished, and the next billion ounces will command a significantly higher price than $59. The squeeze is not approaching. It is already here. I will see you at $100. Subscribe.